תקיפת חיל האוויר נגד מחבלי החמאס הייתה רק הצעד הראשון. ההמשך יהיה קשה בהרבה, ואתם תשלמו את מלוא המחיר. בקרוב יתחיל שוב פינוי האוכלוסייה באזורי הקרבות. אם לא ישוחררו כל החטופים הישראלים והחמאס לא יסולק מעזה, ישראל תפעל בעוצמות שעוד לא הכרתם. קבלו את עצת נשיא ארצות הברית, תחזירו את החטופים ותסלקו את החמאס, ויפתחו לכם אופציות אחרות, כולל יציאה למקומות אחרים בעולם למי שירצה. האלטרנטיבה היא הרס וחורבן מוחלט. תקיפת חיל האוויר.
Just wanted to give both sides of the argument. How are you guys? I'm dead tired. Hey, Carnegie's Painter. I had a long day. And pretty much non-productive day. All right, so what do I see? Possibly what's going on in the market is, we read the headlines, but I think what's going on is there's hedge funds that are just leveraged to 20 to 1, 50 to 1, 100 to 1. And they're in this thing called the basis trade, which is essentially leveraging as much money as you can borrow and doing something with the long bond and the futures. You just are catching the spread, but you do it on such a massive scale that you take enormous risk to get 9%, 10% to your fund. And guess who pays when there's trouble? Guess who pays? The American taxpayer, who has a completely unfair stock market as their reward. So it doesn't look like there's going to be a lot of comments today. Let me just go to try to do this in order. I know there's going to be missing, but here's everything you need to know about the basis trade spooking the markets. According to Bloomberg, this is written by Tracy Alloway and Joe Weisenthal. And I'm not impressed with all of their thoughts, but all right, see, it's not in order. I tried to get it in order. What's this one? Yeah, they're all after Trump's tariffs. Basis trades for dummies. Well, I'll read from the top, and then you'll see it here. Here's what Tracy is worried about. She says, I remember when the basis trade first burst into the market's collective consciousness. It was March of 2020. The stock market was crashing, and Treasury yields had spiked to 1.19%. 1.19%. Now, as yields surged to 4.46%, that doesn't seem like such a big deal. It's actually a really big deal when you go from nothing to 1.19. That's a huge percentage gain. Here we are 5 years later, and the basis trade is in the news again. It's worth taking a detour to explain just what the basis trade is and why it became so popular. We need to go back further than 2020, all the way to Obama's crisis, Bush's crisis. Scarred by the near collapse of the financial system, policymakers moved to make banks safer. They demanded the lenders hold more capital against potential losses and that they carry big buffers of high quality assets which could easily be sold to raise money. The upside of all these measures was a safer banking system, maybe. The downside was shrinking bank balance sheets, diminished liquidity, and diminished risk-taking appetite in the banking system. It was harder and more expensive for big investors to borrow from the banks, the broker-dealers. Without leverage, it was harder for the scumbags to juice their returns. This was also a problem for the banks. Less balance sheet means less room to effectively rent risk to investors, fewer fees. I have no idea where this is. This might be it. But market participants, scumbags, are nothing if not creative, and they found a fix. This was the basis trade. The trade allowed investors, primarily hedge funds and other active managers, to do two things. The basis trade involves betting on the difference between prices of cash treasuries and treasury futures. To do this, they go long the cash bond and short the futures contract. So this cash bond purchase is financed through the vast repo market. And one thing they do, they loan out their gold, get the cash, and they go into this at leverage, at size, where they go into the vast repo market where market participants get their wholesale funding and short-term liquidity by tapping those broker dealers. The profit is the difference between the prices paid for the cash bonds and the futures contract, which they sold, minus the financing costs. Financing costs for U.S. Treasuries are cheap. The trade has the added benefit of amplifying returns for hedge funds. Because the difference between cash bonds and futures is normally small, borrowing overnight, effectively levering the trade, means bigger payouts for the funds. If they do it in enough volume, there was a sizable profit to be made. For broker-dealers, the trade looked pretty sweet too. Post-2008, the regulatory reform meant that they had to be more strategic in how they used their balance sheet. They had to use their balance sheet more strategically. Here's Josh Younger writing in March of 2020. The basis trade has been a common alpha-seeking fund among actively managed funds for many decades, but more recently it has grown because of regulatory constraints, which gives an incentive to large dealers to schedule the use of their balance sheets months in advance, which frequently takes the form of use it or lose it allocations to end users. One way to occupy that sheet with limited downside is buying the futures basis, in which the cash bond is funded in overnight or in term repo and paired with a short position in the futures contract. In principle, this limits the downside by allowing the fund to deliver these securities into the short futures position. I don't know if I'm going to find all this here. I don't know if they all came over. All right, so let's just JP Morgan estimated that the basis trade stood at nearly $400 billion in 2020. But as markets came crashing down in March of 2020, the basis trade transformed into a problem rather than a solution. Suddenly, renting out balance sheets to clients, investors, scumbags, in this way didn't look like a great deal for the banks, the prime brokers, the broker-dealers. Sure, they were paid for the service, but they were in the process of so-called de-risking, and the balance sheet was scarcer than ever. And so banks rushed for the exit, and they did it all at the same time. This left hedge funds in a bit of a basis bother. Sure, they could hold their positions until maturity, which would give them some breathing room to realize losses. But as banks ratcheted down risk en masse, they could no longer roll over their positions. They now had to liquidate their basis trades. To do this, they sold cash treasuries. With banks unable to warehouse additional inventory as they de-risked, the market hit an air pocket. Yields on the benchmark 10-year treasury spiked. The treasury cash market, the treasury market crash was only halted, this is in 2020, when the Federal Reserve stepped in with a raft of measures to stabilize the bond market. the Fed bought $1 trillion worth of bonds in that period. It started buying corporate bonds, and then it bought everything else, bailed out everybody except for you and me. It's worth emphasizing what a departure this was for the Fed. Citigroup analysts talked about how the measures had changed, the regulatory measures had changed the corporate bond market forever. When things got really bad, the assumption was now that the Fed would step in. The same can be said of the Treasury market and the basis trade. There's a belief that the Fed will always be there, hovering in the background. To provide that backstop for bonds, even as regulators simultaneously debate the safety of these trades. Basis trades have the effect of lubricating the Treasury market, arbitraging the difference between cash and futures prices keeps the spread low. Snapping up loads of cash bonds also means there's an added demand for debt at tricky times. When the Fed started tightening its own balance sheet in 2017, this extra layer of absorption was pretty useful. Killing off the basis trade meant killing off a source of additional demand for treasuries and killing off liquidity in the bond market. I'm lost on where that is, so I'm just going to take it down and read this to you. I think I can get back on track when we get down to, I think here we are down here. This left hedge funds in a bit of a basis bother. Okay, so anyway, today, basis trades are bigger than ever. Currently, basis trades are estimated to be worth $800 billion, $1 trillion, according to somebody at Apollo. You can see the rather stunning growth in this Federal Reserve chart from 2024. There it is right there. And it's stunning. You got reds and blues and blacks and grays. And if you look at it long enough, it's as if the artist is asking you to step into the painting. But basis trades aren't the only things going on in bonds. Trump, and see, of course, she's got to get her dig in. She's got to get her dig in. Trump's presidential win set in motion another dynamic, the expectation that banks would suddenly be free from onerous regulatory requirements. This meant betting that cash treasuries would outperform interest rate swaps. Interest rate swaps allow investors to exchange fixed rates for floating rates. They are useful for hedging interest rate exposure. But as dreams of bank deregulation quickly began to die, they also meant the banks could warehouse risk, length, duration, as they call it, without keeping bonds on their balance sheets. Now, with the Trump administration, here she's got to hammer him, not looking so bank friendly, and lenders rushing to de-risk, this trade is also blowing up. Swap spreads, which encapsulate the relationship between U.S. Treasuries and interest rate swaps have plummeted. Our sales would plummet. I can't make sense out of that. It's all right. As discussed last year, the spreads had started surging back in November as Trump looked more and more likely to win, and traders placed what was in effect a bet on deregulation and duration. And then on a macro level, she writes well, but it's rather long. She says more generally, macro level, I guess, there has been a concern about who will buy U.S. Treasury bonds to finance our deficit and our debt. More than deficit, it's our debt. The three main buyers of U.S. Treasuries, commercial banks, foreign governments, and the Fed, have all had their own special reasons to back away. The worry is they are backing away at the same time. Balance sheet constraints mean banks can't hold all these bonds. If treasuries are being sold in high volume, or as she puts it, at scale. By tightening post-2008 banking regulation, really, policymakers help to shift risk out of the banking system to make it safer. Yeah, they just put it out into hedge funds, into prime brokers. But she goes on to say, but they did this at a cost of liquidity in markets, which necessitated emergency moves from the Fed. Here's Josh writing in 2020. I saw that up here. Was this it? No. Everything gets turned around. All right. I'm just going to read it. I was trying to have it here to show you, but I hate it. I need help. More ways than one. So Josh wrote in 2020, the blank market shutdown arguably shows that the bank regulatory structure put up after 2008 can substitute a liquidity crisis for a credit crisis. This is desirable in as much as central banks and other authorities have much more effective tools to deal with the former, a liquidity crisis, provided they are deployed with sufficient speed and scale. In that sense, forceful intervention by the Fed was required by the post-financial crisis regulatory framework. They did it. We know that the Fed is still worried. I'm just going to go back to comments. We know that the Fed is still worried about inflation, especially as, got to blame him again, especially as Trump's tariffs look set to push up the price of goods in the short term. But she knows everything. Before growth slows and demand destruction kicks in. The central bank has been busy shrinking its balance sheet. This is called quantitative taper, QT, or tightening, and may be unwilling to start expanding its balance sheet again. My argument to you is the Fed is going to expand its balance sheet big time. And this, she goes on to say, I think this is the key difference between today and 2020. We know that the Fed does care about bond markets. Really, Bill? I do care. They're the benchmark rate for all other borrowing. And if they go up, it puts real strains on the economy. The difficulty is, in the current climate, it's hard to predict just when the Fed will respond. All right. Is she paid by the word? So far, the deleveraging looks okay-ish, as if she knows what she's talking about. We haven't seen rates in the repo market blow out just yet, but they are moving up, and things can change quickly in the overnight markets. As they say, lack of liquidity kills you quick. And in trying to make sure 2008 never happens again, policymakers have exchanged credit risk for liquidity risk. A key function of central banks is to provide liquidity. And that's why we've all been quoting Bagehot's dictum for more than 150 years. Yeah, she's been around a long time. Central banks should lend freely against good collateral. And U.S. Treasuries are still the best form of collateral out there. Really? But things are really different this time. News coming out of the White House is erratic. Is it? Seems pretty consistent to me. The U.S. seems to be trying to divorce from the rest of the world. Or they're just trying to renegotiate a level playing field. The economy is in a different place than what? Joe Biden's somnolence? And the Fed might be thinking of policy trade-offs in a different way. What a bunch of saying nothing. It's true that the very possibility of the Fed stepping into the bond market again may be enough to calm investors' nerves. But markets are getting spooked instead of soothed. Thank you for all this, Chick. It's great. Tracy. Look, I'm not so sure that the Fed can fix this, but they're going to try, in my opinion. So, Joe, what is Joe thinking about? And Joe, too, the simp, joins in. As Tracy wrote yesterday, we know where the problem is, the White House. What was so great about the economic structure over the last decades? For American working people, what was great? So people are looking all different scenarios. Maybe the Fed acts quickly, blah, 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 Trump, blah, senators, blah. I literally cannot envision. Really? You literally cannot? But just strike literally from that sentence. I cannot envision Mike Johnson bringing something to the floor. Oh, God, it's tedious. They all hate Trump. Now I'm going to skip all the Trump trashing. All right. I skipped it all, thank God. But anyway, I'm worried that we're going to have a highly leveraged hedge fund go down. But I don't think it's going to destroy the market for very long, because I think the Fed will step in. I think the 90-day delay might have been forced by the Fed. It's obviously there for negotiation purposes. But yeah, there's a lot of risk going on. And I think the Fed's going to come in and save the day. Share my referral link. I don't know what referral link I have to share. All right, yeah, let me look at the prices. There's a lot of negative on Twitter, apparently. I don't really watch Twitter too much because it keeps me calmer if I don't. Yeah, GBUX closed at $6.99. The ask is $7.20. The volume 65,000. Imagine there's a lot of negative on Twitter about GBUX. So you have to determine whether you believe the negative or whether accepting the negative, you're still willing to take a chance on the trade, and only you can determine that. My opinion is that it is possible that people out there on both sides are talking their own book. But to me, GBUX trades as if there is a short trap. Now, Ham gave you this idea 10x ago, basically right around here. I think it was a little higher, around 73 cents a share. It's $7 right now. But essentially, 9 to 10x ago. So a lot of people, several people on Twitter are hammering him that it's some sort of terrible thing. But people who listened to him in December and January are up 10x in GBUX. They're up 10 times on their money. So I would call that a pretty terrific call. I didn't get into the stock back then. And so now it's a different question. Does GBUX go from $7 higher, or is this the move? My belief is GBUX has to finish the thought. I read it yesterday to you, so I'm not going to do it again. But they had a news announcement out which talks about $212 million coming into the company, and then 200 or some majority of that. I don't know how much exactly. I bet it's not all of it. They probably have to pay some fees, but to go get yields in a real estate fund. We know that a large investor is giving up shares to lessen dilution. So we need a follow-on press release at some point saying, hey, what we told you was being done is finished. We finished it. And here's the exact particulars. That's what we need. And I think when that comes out, my guess is GBUX will go much higher because it could be buy-in time for the fail to deliver stock, the fail to locate stock. And in that case, the market cap, which is right now 700 million, which I think is pretty high, the market cap won't matter because the price of the stock will get separated from fundamentals as additional day trading, shorting comes in, and then buying, and as the numbers that are rumored out there, which there's no way to prove, and this is something that Wall Street should make more transparent, but it looks like the actual float is around 1.4 million, and the short is 2.5 million shares. Can't prove it. Can't prove it. But that's what I'm hearing. So I think there's a lot more upside in GBUX if things go our way. I think it's highly speculative, and we've already seen how they can knock off 30-40% in a day on very low volume. So it's not for the faint-hearted, and it's not for money that you can't afford just to be wiped out. But if everything comes to fruition, can it go 10x from here? Maybe 5x, maybe more. Who knows? I think there's more upside in GBUX, though, is how I see it. Anyway, that's my answer on GBUX. I don't know what this is. I hit this. It says share. I don't know what it is. It'll be very costly to whoever shorted GBUX. I agree with that. Rule 144. Well, yeah. Prevent insiders from flooding the market. Blah, blah, blah. Well, 144 stock, it's usually 6 months. It can be longer, but your shares are restricted. So if you've been given a big award of stock, or you had a payday and they paid you in stock, or any number of reasons, or if you're an investor in the stock as an insider, they'll give you restricted shares. There'll be a legend on your certificate. And in the United States, that's 6 months. I can't think of any time when it hasn't been 6 months. I suppose a company could say we're going to put it out there for a longer term, but the rule 144 is 6 months, and you can't trade the stock, but they do trade it. The Kramers, the Linds, the Yorkvilles, the Aubreys, they all trade it against that. It's illegal, but nobody cares. Do you notice a pattern? Our system is corrupted. Anyone buying the dip? The other day I said I was from Mount Jackson. It's in the Shenandoah Valley below Winchester. Yeah, I remember Winchester is beautiful. I think they're building a Catholic monastery or something up there. I think somewhere. I've heard it before, but you aren't too far. Well, you are. You're north of Roanoke, where they say out in a boot and hoose. I'm still holding my 6,000. That's a nice position. And I like your position of Nixie. I like both those trades, Brandon. I don't have as much, but that's just my situ now. But I think Nixie has a good chance. Look, these are speculative stocks. Nixie has a chance of, if you use the analogy of a pickup truck stuck in the ditch, a muddy ditch, they'll spin the wheels, I think, at least one more time. Will they gain purchase? Is there enough weight in the bed of the truck? Is there enough rock or other material that's been put down, or has the ditch dried a little bit? We don't know. Personally, I think it's high odds that Nixie is going to spin its wheels again. Whether it gains purchase or not, I think it's 50-50. I think with GBUX, same sort of thing. I think it's going to have a reason to go up. It's just simply because they have to finish the news. They have to finish the thought on the press releases they've already put out. And I think GBUX, if it goes, and I'm like to 10 or 11 or 12, there's no real reason why it has to stop there. So it could be fun. I'm not sure. I'm not sure it'll get blocked out. All right, Donald Beaulieu. Hey, Steve. Did they have a press release? Well, let's see what their press release says. Of course, my service says there's no news. So let me go to wow. There is a press release, Justin. 5 hours ago. And I heard about that 50 million gold idea somewhere else, not related to GBUX. So maybe it's the same thing. Maybe it isn't. Somebody was shopping it. All right, so 5 hours ago, GBUX announced it has signed a letter of intent. Oh, God. To buy the interests of Charterhouse, gold-based and related financial services. Non-binding. 1 million shares. Subject to Rule 144. And they're going to raise money in a preferred stock. They're doing what, they're going to become a seller of coins. It's actually a pretty competitive business. And these gold-backed credit cards, they're out there. Gold Fix is one. I think that's a good idea if it takes off in the Middle East, I guess. It's good. It's gold. And it's a business that I think would have a lot of applicability in the Middle East in particular. If you had a credit card that was tied to a gold account, 50 million is a pretty good number to start minting coins with, freedom rounds as they call it. I think that's all a very good strategy. But in terms of that announcement, That's another announcement that needs the other shoe to drop. Whenever you put letter of intent and money to be raised, that's the lifeblood of the criminals. They start selling stock. But in this case, it's a little different, I think, because it's obvious that the sources of funds are not going to be Wall Street. And therefore, anyone shorting the stock is going to be in trouble. Are you throwing good money after bad on ZJYL? I don't know. I have no idea. ZJYL and GDC were two stocks which had basically the same story and probably somewhat overlapping investors. Whales, big investors, own the majority of the float, if not all of the float. There's a short position. They own more stock than what's in. The short position is larger than the float. The whales own, in one case, more stock than what's in the float. This is the basic short squeeze story. Last year, one gentleman heard about it getting ready to go. He started telling the story on Twitter. And what he started posting was material information which had not been shared with the public. As I understand it, the lawyers said, you can't go ahead with this. You're going to get in trouble. Any money you make, they're just going to take away from you. So because that person, and it might have been more than one person, opened their mouth and started pitching it on Twitter, the whales and the company and the buyers and everyone just walked away. They just stepped back. And they didn't do anything. Stopped buying, no follow through at all. And here we are 6 months later, and you're impatient. Well, am I throwing money away because nothing's happened? No, it's the same story. It's the same story. I think 6 months is enough time for whatever, I don't even know what it was, but whatever was on Twitter to be distributed to everybody. It's enough time for price action to settle down so that there will be no investigation of what was said on Twitter at the same time as the stock was going up, because the stock never took off. It never really went up because they moved away. Well, am I going to be throwing good money after bad? Steve, I think GBUX is the most immediate story on your deck. But I think there's risk in it. It's got a very high market cap. It's obviously got selling going on. The information that I have is rumors, and so it's very hard to rely on. But whatever's going to happen with GBUX, I think will probably happen relatively soon. And I however good the story is, I would just get out on whatever the trade does if it goes up. And it's highly speculative. What I think will make GBUX go up is they have a second piece of news. They have to drop the other shoe on two pieces of news. I believe GBUX is going to go up. but it's a crapshoot. But I think it's soon. Secondly, I think Nixie is very soon. Nixie is a little more squishy because the stock has tried to get up off its ass twice before, did a lot of volume and went nowhere. So if it does it again, is it going to go somewhere? I'd say it's 50-50. But I do believe Nixie's in the same situation where they've already made announcements. They need to drop the other shoe or two shoes. And I think Nixie could happen relatively soon. Railtown, which has nothing to do with any kind of chasing, any kind of, there's a big short position, and there's two guys in Florida that are trapped, and there's some guys and there's whales that own a big part of it, and the float's this big and the short's this big. That's not the story at all in Railtown. Although Railtown could have a short position and a short squeeze story, that's not the story with Railtown. Railtown simply is a stock that spent 4 years, a company that spent approximately 4 years developing a software. They call it large language learning models or something, just to confuse everything. They created a product that is in demand for companies so that instead of spending tens of millions of dollars on a team and a year and a half going into legacy software, you just turn on this AI, it's called Conductor, and they can locate the problem, fix the problem, upgrade the software in the legacy system in a matter of minutes or hours or days for a fraction of the cost. They've gone from R&D to product that they're selling. They're the first to move. It's a $100 billion marketplace. If they get 25% of that, that's 25 billion in revenue. Apparently the multiples prior to this correction in the market that were being paid for companies' revenues in the AI space used to be 19x. Let's just call it 10x. 10x times 25 billion, $250 billion company with 150 million shares outstanding. That's the Railtown story prior to something else that came along. Railtown ran into in British Columbia when they went to that best of class conference. They ran into a company called AI Partners with 160 AI companies and investors. And they're buying it. They're buying it. They announced it. They announced it 7 weeks ago. It needs approval from Canadian SEC. They call it the Bureau, I guess. Bureaucrats can do anything, but there should be no problem with approval. Two of the big investors in that company founded Congress software, that's not it. Congolese software, that's not it. Confectionery software. Anyway, they founded a company that went from pennies to $4,000 a share. And now they are majorly involved here. According to a release, a Twitter release from the PR person at Railtown. So the story got even better. I think Railtown, there should be, again, it's the same thing. They announced this 7 weeks ago. When are they going to put the final shoe drop on the floor? I don't think it's very much longer. And Railtown, which sits at 26 cents because nobody can buy it, nobody buys it. If you were in Walmart and they came out and said Railtown, attention all customers, in aisle 7, we're having a sale on Railtown, normally sells for 36 cents. It's available for a third off at 26 cents in aisle 7. Attention all customers. There'd be a line down the block, but not in the market. Oh my gosh, the stock's down, and I lost all ability to think. And I didn't really understand the story in the first place. But if I understand it, they've entered into a merger agreement with a large company, and there's a quiet period. The company they're using is Canaccord. Canaccord can't tell their clients to buy it until the deal is approved. The shareholders in Railtown can't buy more because it's material information. They have to wait until it's approved. And all the shareholders of 160 companies in AI Partners can't buy, or most of them. So there's no buying, but the stock's down, so I'm not going to buy anymore. I mean, come on. That's silly. Why would I buy more? So I think Railtown is going to surprise people once there's news. It's just, again, it's just the second shoe dropping from news that's already announced. Once that comes out, I think the pent-up demand for Railtown stock could give you 10x. All of those, I think, are immediate. ZJYL and GDC, the people involved there stepped away when somebody blabbed on Twitter, put out information that shouldn't have been put out. And we're waiting for the consequence of that. And unfortunately, there's waiting. But as far as I know, none of the whales have sold. The setup is the same. Can there be a surprise? Probably not, because it's been out there. Can there be buying? Sure. Can there be a buy-in? Sure. But I think the stock price will have to go a lot higher. But there's no immediate, obvious reason why ZJYL or GDC would trade quickly upward in the next 2 weeks. Approximately. I think there's reasons why GBUX could, highly risky. There are reasons why Nixie could try to, highly risky. There are reasons why Railtown will possibly have a chance to go up. I don't think Railtown has much risk at all. So why you would add money to ZJYL when there's those 3 stories there? You must already own as much as you want to own of those 3. And that's fine. That's fine. But ZJYL and GDC, if I had money, I'd buy them. But you got to be prepared to wait. One day you'll wake up and, oh my gosh, what's happening? The stock's up. It's all the way. Oh my gosh, it's 7, it's 8, it's 20. I mean, I'm dreaming. I'm not predicting. I'm not promising. But that could happen. But you got to follow your own instincts. Just because a stock is dead in the water does not mean that it's good money after bad. Unless the story's changed. And each one of these bears is a different bear. And you got to listen to it and be responsible for your own thinking on it. But if I had money to put into something right now, the safest, these are all speculative, so none of them are safe. but the safest of the lot, I think, is Railtown. Risk reward. In terms of urgency, timing, I think Railtown's right in there with Nixie and GBUX. I think GBUX has the highest market cap, so almost by definition, it might be the riskiest. Nixie has tried to come out of the ditch twice before. The shorts know all about it. It's run by Brent, who you can see his handiwork in logic. So there's some risks. On the other hand, Nixie has big investors. It's got the same basic story of a low market cap, low float, big players in it, trying to be $1 billion company. They're going to merge a bunch of companies in, and there's going to be the second shoe dropping from before. It's a pain in the ass to wait. But that's how you make money. Do you think the person in your neighborhood who sold in downtown or in the suburbs, who sold the property to the Hyatt for $20 million, do you think they bought it just last week? They bought it 15 years ago. They had to wait. The only person that ever bought property and doubled or tripled his money in the billions is the guy who bought the World Trade Center just before the jets went into it, and he double insured it. The fact that he was Jewish has nothing to do with it. It's just a guy that got lucky. No, there is no money raised for the gold project in Nevada. We're waiting on $5 million and it hasn't come in. They raised $1.3 million outside of the 500 that we raised, and so the project moved forward. That is a fact, but the 5 million hasn't come in yet. Let's just talk about that. Let's just talk about that. Damn it. As soon as some things move, people get impatient on others, and it's just, has enough money been raised? No. And you know that answer. Okay. From June of 2017, I can't find the other report. I'll just go through this one. It's oddly very similar amount of outstanding shares because they've been careful not to overissue shares. They have palladium and gold, which have had at that time given 0.59 ounces per ton of gold equivalent. I'm wrong. The 0.59 of palladium at that time gave 0.354 ounces of gold equivalent. 0.35 ounces of gold equivalent per ton. And they think that they may add to that the gold recovery 0.265 per ton for a total of 0.6 ounces of gold per ton. I have always left the palladium off and just focused on the gold because it's why complicate things. So at 0.6 ounces of gold per ton, with 165 million, at the time, it would equate to 165 million ounces. It's half an ounce per share resource at that time, possibly worth $50 a share. Gold was trading, well, we'll find out where gold was trading as we go through this. They raised money at 8 cents a share for this 5 years ago. It's a little more than 5 years, it's about 7 years ago, 6 or 7 years ago. So the company announced high levels of palladium recovery at 0.35 ounces of gold equivalent. That was an unexpected and exceptionally high discovery. And the company also announced gold recovery of 0.2 to 0.265 ounces of gold per ton separately from the palladium, from hundreds of lab and production scale tests. The palladium results were from a test scale smelting furnace installed in 2016, unexpectedly high, and giving the parameters for a new pilot plant. New smelting furnaces with closed circuits are to be installed. They're going to run the furnaces, this was 6 years ago, at 500-pound sizes of concentrate in the pilot plant and running the equivalent of 7.5 tons a day. This would fully establish the metallurgy and allow for the determination of a full-on plant project economics. In other words, building a production plant. What would the economics be for a full-sized production plant? They've done consistent hundreds of lab and plant scale tests, and they've achieved 0.20 ounces of gold recovered per ton. And then, of course, the palladium as well, but I choose to ignore the palladium. We had previously heard a figure of the cost per ounce of $400 per ounce to process this resource. So using 0.265 ounces per ton, that's how we came up with the $400 per ounce. If you give credit for the palladium, you could be down to $200 an ounce in costs. The average North American mining company has mining costs like Barrick, Newmont, of around, at this time, of around $800 an ounce. That number is much higher now. It's around $1,200 an ounce. And he points out that what happened in 2016 is the cost per ounce went down a little bit because companies were focusing on their highest grade resources. So that brought it down to 800. But typically, he's saying here, it can cost $1,200 to $1,500 an ounce to recover gold in a typical mine. So the company needs to reassay with independent eyes, independent engineering firm, 174 million tons that were previously third-party measured, which was assayed in the past at 0.04 ounces per ton. They expect to increase the total resource conservatively to 274 million tons at 0.6 ounces per ton. That could give 165 million ounces of gold equivalent. Another way to get to a number that high is if you, and I've done it before, if you just stick with what we know, which is that in the 174 million tons that they've already drilled with third-party eyeballs down to 200 feet, and they took some of the holes down to 400 feet and found identical resources. But just in the 200 feet, in the north zone and in the south zone, at 0.2 ounces of gold recovery, it's 35 million ounces of gold. And if you were to assume going down to 400 feet and just drilling in between, you can get to 70 million or higher, as much as 100 million ounces of gold at 0.2. If you go outward in both directions, they have over what's estimated, and there's no reason to believe it's not there. They have over 1 billion tons, 1 billion tons. They have as much as 1.5 billion or more tons of sand. And if you assume 0.2, I think it's risky to assume that it everywhere is all the same. But on the same token, many of the zones could be much higher. It's kind of like when you open up a gallon of ice cream with caramel swirl in there. Some scoops have a lot of caramel and others have less. But anyway, if you take 1 billion tons of sand at 0.2, you get 200 million ounces of gold. But you don't need all that to make this one of the best investments that's ever been presented. You can just go with the two ways to be conservative. You could take the 1 billion tons and just use 0.04. That's 40 million ounces of gold. Or you could just say, we're not going to find any more gold. We're not going to increase the grade. we're just going to go with what we third-partied already in terms of sand, and we'll use 0.04. I think it's really 0.038, but anyway, we'll use 0.04 ounce of gold recovery with third-party eyeballs, third-party assay method. Just for that, we will assume that you don't increase the grade and you don't do any further drilling. Just for that, that's almost 7 million. Let's call it 6 million ounces of gold. If it costs, let's use a high number, $1,000 an ounce, and gold right now selling at 3,000. Your profit is $2,000 an ounce times 6 million ounces. So that's obviously 12. I just don't know how many zeros are in it. So 6 million ounces times $2,000 profit. That's $12 billion just with what is there that they third-partied. Don't drill deeper. Don't drill in between. Don't drill on either side. Don't do any of that. Don't assume that the hundreds of lab tests at 0.2, actually 0.26, just don't assume any of that works. And don't assume 7 million ounces. Assume 6 million ounces of gold. 6 million ounces of gold times $2,000 profit per ounce. It's $12 billion. Right now, there's 400 million shares extant. By the time we convert our shares and there's more money raised, maybe there's 500 million out. Let's use 1 billion. Let's use 1 billion shares. This will be one of our other ways of being conservative. So when you divide $12 billion profit, and with gold, you don't present value that very much. Why? Because gold reflects inflation. You present value that at 1 billion shares, that's $12 a share. What did you pay? You paid 4 cents. You also received 1 warrant for every share that you purchased. So if you exercise those, which you will, it'll probably end up being cashless, you will have double the amount of stock at 4 cents than you paid for now. But $12 divided by 4 cents gives you 300x, 300 times your money. It's a pain in the ass waiting. It's a pain in the ass that nothing has happened. It's a pain in the ass. There's action out there. Yes, logic crapped out completely. Logic is a complete waste product as far as I'm concerned. I think Brent needed to probably calm the fires at home, move on to Nixie where it's more exciting. So he just washed his hands of logic. I think logic is a wipeout. I'm going to lose everything I put into logic. Pain in the ass. Collective audience. I have collective audience. That's going to turn to shit too, I think. Already is. So what's left? I lost money in GTII. I lost money at the end of the day in Finger, but I think Finger will be fine. I lost money in whatever that stupid thing was, CRTD Vocal. So therefore, I'm going to lose money in this one because I lost money in those. Well, I don't think that thinking works. I don't think that thinking works. Why? This company doesn't trade. There is no shorting, but you need to put it out there in this public forum so the criminals can do their homework. I don't trust them, but that's all right. I'm not scared of them. Not scared of them. But you don't think they come after us? Let's just be innocent. We'll come out here. We'll talk about it. Let's act innocent like victims. I don't trust most of the bastards that come on here as shills and comment. They take money from us. But anyway, we'll talk about it. You need to know here 2 weeks after the last time you asked. The company is not subject to toxic financing. It is not subject to short selling. Now, there's a debate inside the company whether or not it's a publicly traded company or not. Everything I see, it's absolutely not. It's a private company. But it used to be a public company. It used to be. So they don't want to give up on that. But the point is, there is no shorting of it. I would prefer if we just didn't effing talk about it, because I think this is a massive upside. I don't trust what all these criminals can do. But anyway, we're talking about it. I understand it. I have money in it. It bothers me too. So what's the worst thing that can happen to this company? It doesn't raise the money. The money never comes in. Or the money takes another 1.5 years to get through the regulatory process. And in that time frame, the shareholders, who are all elderly, decide, you know what, screw this. We're going to sell to the guy that made the offer to buy the company a year ago. And his last offer was capped out at 20 cents a share. So we took the risk. And as soon as we made 20 cents a share, he owned the whole thing, lock, stock, and barrel. Let's go back to him at 40 cents. We'll just do it at 40 cents. We're 85 years old collectively. We don't have much longer. We want our children to get this, our grandchildren. Let's just do it. Let's just do something. We're tired of waiting. That, I think, could happen. That could happen. That the company raises money in a very bad way, very negative way, with a cap of 40 cents a share. That's where we're headed. That's one alternative. I don't want that to happen. Secondly, the company could decide to raise another $1 million from an alternative investor, just like they already did. And that would buy another 9 months, a year, to wait for the regulators to approve the release of funds. What would happen in that case? Probably not much to us, not much. It wouldn't affect our return. We'd probably have to wait a little longer. but it probably would be a good thing. And then finally, what could happen is this money comes in. And I know one thing, asking about it every 2 weeks, 1 week, 3 weeks is going to make it come in more quickly. I know that. I also know that talking about it out here in the open will keep the bad guys involved, which we'll have to deal with that if they gain any purchase on it. So the negatives, as I see it, is we lose complete control of this company, and it's just sold to this other guy, very wealthy guy, with a cap at 40 cents a share. Well, you paid 4 cents. That's 10 times your money. I think it's shitty, but that's 10 times your money. Okay, that's the financing side. I already showed you at $12, which I think is one of the most conservative ways of looking at this asset. $12 is 300 times your money. What's another way to look at it? That the pilot plant does indeed produce at 0.26, let's call it 0.20 ounces of gold, that there is drilling down to 4 feet, that they just stick with the 2 zones, so it doubles the amount, just doubles the amount. Nothing in between, nothing on either side, just where they are. So that 174 million tons of sand becomes 348. Let's call it 350. Let's call it 348 million tons times 0.2. So again, taking the north zone, which has already been assayed by third party, and the south zone down to 200 feet. They drilled several wells, holes down through 400, and it was always there. So the only assumption I'm making here is that they drill down to 400 feet right there. Nothing in between, nothing outward. I'm also making the assumption that the hundreds of tests prove out once the pilot plant is built. That gives you 69,600,000 ounces of gold. For ease of memory, I'm going to call it 70 million ounces of gold. 70 million ounces of gold. Times, with that higher grade, you've got to take the cost per ounce downward. So I'm going to say times 2,500 an ounce at today's prices. That's $175 billion. $175 billion. Now, will they produce that themselves? That's what I'd like them to do. Will they sell the company? So it gets into a trick. What do you sell the company for? But taking it right on that value, dividing that by 1 billion shares, it's $175 a share. $175 a share. Let's just assume they develop it themselves just to be wildly bullish. That gives you a return of over 4,000 times on your money. Now, that's financing. Let's say they sell the company based on those numbers. Probably, I would guess it gets tricky. I would guess they'd sell it at much lower numbers. I'd say $300 or $400 an ounce of gold if they just outright sold the company with an override. So let's just say that our recovery could be somewhere between $12 and $175 a share. And if the company just gets sold, it's going to be much closer to the lower end of that number. So you paid 4 cents. Pain in the ass waiting. Pain in the fucking ass waiting. But from all the financing sides that I see, the worst scenario is if these guys get impatient and just fob it off. I don't think they will, but it could happen. And all this success happens, it'll accrue to that guy. But we'll make 10 times our money. If we can control it and do project financing, conceptually, we could make 4,000 or 5,000 times on our money. Now, I negotiated a deal that got warrants. If you listen, for example, to Rick Rule, the one thing you try to do when you're buying a mining company is invest and get warrants. I did that 1 for 1. I didn't really emphasize it, but that's what I did. Now, what is more likely than that $175 a share is there'll be some sort of joint venture. And if there's a joint venture, would it be split 50-50? They put up all the money, they do everything? Probably. So it'd be half of that. But I always used the numbers. You pay 4 cents. To me, the low end of the return, well, obviously we have to expect that we can lose everything. It can go to zero. Absolutely. But in return for that risk, the low end of our recovery is 10x at 40 cents. And then trying to use just really conservative numbers. If they just sold the company to Newmont and Barrick Gold, and they just process the sand in their autoclaves, over time, I think it's very conservative. We get $4 a share. It's 100 times your money. And if we did a JV, or if we sold the company with an override, or if we did some kind of financing that gave up shares, gave up upside, I think it's going to be more than this. I just showed you. I think it could be a lot more than this. But I used the number $40. It's 1,000 times your investment. So yes, the money hasn't come in, but I think if everything works, you're going to be well paid for the fact that this stock isn't trading and it's not moving. Everything else is moving. Unfortunately, I don't see it giving you a nest egg right now, or a roll of money right now to trade these other stocks or me. I think there was basically $1.5 million, $1.6 million raised. And I think that has given enough money to keep the leases, to keep the overhead through this year. And there's some people that want to put up money. They've sent me emails. I haven't called the company with those people's money yet because I guess just because I want the larger money to come in. When that comes in, I'll say, hey, I have these other people that are interested. I think the answer would be no right now. I don't know. I should test that. But I think there's enough money to get through to the end of the year without any problem, maybe a little bit further. With the $1 million, $1.5 million, I think some of the money went to the gentleman to cover the monies he had fronted the company. I don't know that for a fact. I'm not on the board. I'm not close to the company in that sense. I'm just an investor. I've asked to be on the board, but and I was promised that I would be, but another guy got involved who has a little bit of money in it, and the CEO, he's not even the CEO, he's a board member himself. He trusts that guy more than he, I don't know what's going on, but I'm not on the board. That money raised, I think in part went to pay back the guy that fronted the money for testing. However, that did also give enough money to order machinery and parts and design what's going to be built. But there's no question they need the 5 million or a good chunk of it anyway soon. It's not available. I don't know when it'll be available. I ask about it. My opinion is it's probably not going to come until June, probably June 1, July. But even if I give you that, it'll be later. There's nothing to be done. There's no way to speed it up. And so it's a waiting game. It's not the company's fault. It's my fault. It's my fault. It's not the company's fault. Now, what happened 6 years ago that they didn't just get it done then? Well, a few things. One is there was an earthquake not 6 years ago. I think it was about 4 years ago that destroyed. I haven't ever visited, so I don't know the full extent of the damage, but apparently it destroyed what was there. Also, the medical emergency worldwide came through. But more importantly, the testing process they had at that time counted on attraction, chemistry, valences, I guess, but positive charges and negative charges. And when they set it up prior to the earthquake, the charge of the earth interfered with the process. So what the gentleman did over the last, well, he hasn't done much new in the last year, but over the last 4 of the last 5 years, is he fronted over $1 million, $1.5 million, bought the, the Batman telescopes, did a lot of testing, and came up with 2 processes I think I've removed all the names there. But this, you can see here the 174 million tons at 0.038 recovery. And it gives, I can't see it, darn it. I'll just read, oh, there it is, 6.6 million ounces of gold. Now, this was what was presented a year ago, a little over a year ago. The company discovered 6.6 million ounces of gold in felsic sands of a basin in 2010. Gold resources were 174 million tons at essentially 0.04 ounces per ton by using caustic fusion. Caustic fusion. Gold resources were 174 million tons at 0.038 ounces per ton gold equivalent. By caustic fusion assay, 37 200-foot sonic drill holes by third party. So they did an assay of 37 200-foot sonic drill holes. The grade was confirmed by a 24-ton bulk leach test using sodium thiosulfate to yield actually 0.048 ounces per ton in 4 separate leaches. Anyway, the evolution of gold extraction from these sands is shown in the graph below. The increase in the gold extracted corresponds to uncovering the true nature of the gold in these sands. Electron microscope work proved that the gold occurs in nano gold clusters and is extracted as refractory nano gold particles. In other words, it's coated. And then a couple of things they do to the work, identified the chemistry, and he came up with these 2 methods, TPAC and NMET. So let me just make sure. Yeah. So here's the graph. Here's the graph of, on this side of the graph, it's the amount of gold recovered per ton. And this is the caustic fusion assay, came in at 0.04. And then this is the, whatever he said, thiosulfite, whatever, came in basically the same. And he's got these other test methods, assay methods, that all confirm gold can be recovered. Remember, about 150 miles away in the Gold Strike complex that made Newmont Mining one of the world's largest gold companies. It was a penny stock prior to that. They process, Newmont and Barrick Gold process gold that is at 0.03 ounces per ton of sand. They process in these large autoclaves just down the highway. It's the Carlin trend, and this is an analog to the Carlin trend in Nevada. So anyway, then you get the 2 yellows. These are the 2 methods that he he had third-party testing on. The green is the one that he has created, that he wants to use, but he's created these two over the 4 of the last 5 years, comes in at 0.2 ounces per ton. Actually comes in higher, but he's just using 2 ounces per ton. So in 2023, he calls it nanotechnical knowledge. By his work, improved the gold extraction from 0.038 ounces per ton by caustic fusion in 2010 to 0.20 ounces per ton using the NMET or the TPAC methods. And there, he gave an appendix for the details. I don't have it here. Just to, I can't show. I signed an NDA. I can't show the details. All assay and resource calculations were done by independent geologists, engineers in a chain of custody sample method collected from the sonically drilled holes. Now, this, I put a business card on the top of the name, but this is the site, and it is a caldera. It's a volcano. It's a very old volcano. Very old volcano. And here is the acreage. Here. It's on this side. This is a large play. Up north here is a huge silver resource that is being developed. And then the Carlin Trend is out here. So when the earthquake came, this whole caldera shook like a bowl of jelly. And obviously it did some damage on the plant. But what it showed is that this resource goes very deep. So you may have 600 feet, you may have 800 feet of sand. You then have clays, and then you have water. Or it's sand and then seawater and then clays. I don't know, brine. They have brine. All of it is prospective for gold. But anyway, and these other areas may be something that a larger player would go after. But this is our little acreage that's leased. The proprietary NMET leach method, he says it's been under development for over 25 years, and I suppose that's true. He's in his 70s, late 70s. To date, the NMET extracted gold has averaged 0.2 ounces per ton, and then the pilot plant proposed would use the NMET leach and is scheduled and would go through. Once the money comes in, this can be finished. I mean, if we got the money, I think it's dreaming, but if we got the money this month, I think this could all be finished by October and maybe even sold before the end of the year. But I don't think the money's coming anytime soon. I think the money is going to take a while. It's just how life is. It's just I've been anxious about it now for, I don't know, at least 6 months, probably more like 8 months, and I just don't think the pain is over with. I think we got to wait, but nobody knows. You can't predict it. There's no way to put any leverage on it, and it's a pain in the ass. But I think the reward here is just off the charts. What could make it crap out and just go to zero? I suppose that the things that could make it go to zero would be if the guy running it dies. But I really don't think that would make it go to zero, because the process, there's a team there, and there's more than one process to remove gold. So I don't think it would go to zero. But that certainly is one risk as people get older. Another risk would be that the company does have financing with Lynn Partners or Aubrey Advisors or Yorkville or the Kramers or something like that. As long as I'm alive, that's not going to happen. That will not happen. But it's always a risk because they control the markets, and you want to talk about it out in the open, so they will try to do it. But I don't think anything can get done along those lines because I'll be there. What's another risk for it to go to zero? I guess once they build the pilot plant, maybe for some reason it doesn't work. As it said here in this research report, and there's another report somewhere that I can't grab quickly, might be over there, but they've done hundreds of lab and pilot size tests. So I don't think that's going to be an issue. Now, the previous issue was one of interference from the Earth. So whatever it is the Earth a positive charged item? I don't know. Or it's negative? I don't know. Well, the new processes do not require attraction. So that's not going to be an issue. That's not going to be an issue. And I've grilled them quite a bit on that, and I'm convinced that's not going to be an issue at all. And then what else could make it not work? I can't think of anything. So it should work. I suppose if gold went to $400 an ounce, that would make it a non-economic project. And, that's always possible. That's about it. I don't think any of those situations are going to occur. On the positive side, you've got dedicated investors. The guy running it for the time being is fighting for shareholders and fighting to make sure it works. All we're waiting for is the money to come in. I negotiated my ass off to get the deal to be better, but the money's coming in on essentially the same terms that we put it in. I tried really hard to get a much better deal. I couldn't get it. That was weeks of negotiating, if not longer. I couldn't get any better. So this money that comes in is going to essentially come in, to my memory, it's the same deal we have. I take that as a positive. Take that as a huge positive. But I think it's going to be, I don't expect the money to come in for at least 90 days. And if I can hold it together that long, great. If I can't, great. So I can understand being frustrated. I'm frustrated, but I think it's going to be another 90 days. It'll probably be whatever is July, 6 months or 7 months. It'll be July. We're not dealing with business people. We're dealing with bureaucrats right now. And I think you have to get ready. It's going to take a long time. And I'm sorry about that. That's just how it is. The blessing is that it's not out there being destroyed by criminals. The deal is set. It's not going to be destroyed by the stock price being crushed and the amount of shares out there. The arithmetic is just astounding on what, I mean, this is literally an on-off switch. If it works, there's no reason that it's just going to be on the small end. There's every reason it could be 200 million ounces of gold. 200 million ounces of gold at 2,500 an ounce profit. I mean, it's scary numbers. It's $500 billion. $500 billion. And I don't think it'll be 1 billion shares, but let's use 1 billion shares. That's $500 a share. What if it does that over time? Call it $400 a share. 400 divided by 0.04. 10,000 times our investment. These are the numbers. The cycle in the miners has been very difficult. There's no money going to the mining companies until right now. PDAC, about a month ago, the money started, according to people I listened to, the money started flowing. The bigger miners are profitable. They're making money. They're paying down the debt they have to the private equity firms. And there's going to be money now to acquire smaller companies and projects. And that's the cycle. The deal you locked into was as basement price as you possibly could have gotten. I'm telling you, I tried everything I could do to get it cheaper. And I did get a double with the warrants. So what I think is going to happen, though, gold and silver needs to go up considerably. Wall Street needs to be educated on gold and silver and palladium and platinum. They got to start moving money from their managed accounts over, but they got to figure out a way they can make fees by recommending gold and silver. And I assume it'll be ETFs. It might be an internal investment product, the Merrill Lynch Precious Metals Trust Plus Opportunity Fund 1. But they'll come. That's coming. You can see it coming. But so first you have to get the resources moving. They already have. Gold's gone to 3,000. They're going to go higher, I think. But then you're going to see the blue chip companies go. Newmont Mining, Barrick Gold, Anico, Franco-Nevada, Wheaton Precious Metals. I always say the same ones. There must be some other names out there. Some of the ETFs will go. But I think some of the companies that will start trading up to very high numbers Franco-Nevada, I mentioned to you. I'm just going by what Stephen Lieb would tell you. Newmont and Barrick. Fresnillo is a smaller company. Endeavor Mining, International Tower Hills. These are medium-sized. Gabriel Resources. Nova Gold. These are junior miners. So what you're going to see is the product has to go up. Then those bigger companies move. ETFs will go. And he has a list of ETFs. I'm not a big fan of the ETFs, but GDX tracks 45 gold stocks with the majors. The three biggest are Newmont Gold Corp, Barrick, and Franco-Nevada. That's about 30% of GDX. This is a handful of years ago. And then there's the junior miners, GDX, which oddly, up until recently anyway, is pretty much the same as the majors, but they include Nova Gold and Endeavor. And then there's an ETF which he recommends called Global X Explorers. And then he does mention the Sprott Gold Miners ETF, SDGM, which is a collection of gold stocks chosen by analysts rather than chosen by an index. And anyway, the money will start going into those. And then it'll get to the mid-size, the small size, and where our company is it's unknown, really. It's not on the charts. Wall Street's going to have to hire analysts. They're going to have to train analysts to go into the precious metals sector. It's going to be a process. But I'd say within 18 months, with performance at the pilot plant, with companies coming in like Barrick Gold and Newmont to do the process themselves, And by the way, I can go to Rick Rule and get project financing. He told me, I have his card right here. He told me, whenever you get your white paper, show it to me. We'll finance it. So I assume if it's good, he'll finance it. But we're just not there yet. And but my point is, I think over the next 18 months, I think you're going to be very happy with what transpires. But for the time being, the 5 million hasn't come in. I would plan on it being at least another 90 days. So that brings up the risk that somebody else comes in and stirs the pot. And that's just how it goes. It's just how it goes. They did raise enough that the company's not in risk of there's no debt per se. I mean, there's some to this gentleman, but there's no unfriendly debt. There's no way the company is going to have to seek reorganization or anything like that. So it should be fine, but I'd say it's at least another 90 days before the larger money comes in. And that right now is the best I can do to give you an update. You know, I can't do anything. It's like being at DMV. You know, I could throw a hissy fit, which will have the exact opposite effect. I could go up and knock on the gentleman's window every 5 minutes, which would have the opposite effect. I can go sit and do the crossword puzzle and just be there when the bureaucrat is ready to say, okay, we're done. Best I can do. Rail, I don't know where it's trading on its price, like 26 cents, 25 cents. Look, Rail, well, let's go through it. I guess there's nothing like just repeating the same thing again. So Railtown closed at 27 cents, it looks like. Last month, Railtown announced a memorandum of understanding to acquire AI Partnerships Corp. 3 months ago, Railtown joined AI Partnerships. 3 months ago, Railtown presented at the AI in British Columbia demo night. 3 months ago, Railtown was accepted into the Advanced Micro Devices Partner Network, AMD, to accelerate AI-driven innovation. 3 months ago, Railtown announced the closing of a private placement, non-brokered. And 4 months ago, Railtown announced a European marketing agreement. 4 months ago, they achieved an SOC 2 Type 2 compliance certification. My understanding is that's huge in terms of getting contracts and being bought out, frankly. And then they participated in a summit. And then 6 months ago, Railtown launches a large-scale customer acquisition campaign. And they presented at Think Equity. And they did a partnership with somebody. They did another placement. And they got research coverage 9 months ago. Let's see what that says. Research Capital initiates Railtown AI with a speculative buy. Railtown Technologies advanced AI for efficient software development. I tried to get a copy of it. You can't. You have to somehow. So I've never seen a copy of that report. All right. So coming back to the top. Let's just read the Railtown joins AI partnerships. Railtown is a global network. Let's see. Railtown pleased to announce that it has joined AI Partnerships Corporation Affiliate Network, AIP. AIP is a global network of AI SaaS, software as a solution, affiliate companies that foster collaboration between innovative AI companies and enterprises seeking cutting-edge AI solutions. Through its network, AI connects forward-thinking affiliate organizations, enabling strategic partnerships and expanding market opportunities. By joining it, Railtown gains access to a global ecosystem of over 165 affiliate companies, which include enterprises, technology leaders, and partners actively seeking and delivering AI-driven solutions to clients. This will further expose Railtown solutions to a customer base. We are thrilled to join. Everything is thrilling. All right, so then we'll come back. And last month, Railtown AI Technologies announces a memorandum of understanding. MOU means computers start selling. Computers start selling. MOU, sell, destroy. To acquire AI Partnerships Corp. Railtown is pleased to announce it executed MOU for the acquisition, not just joining it, they're going to acquire it, of AI Partnerships Corp. Over 160 AI SaaS companies that provide AI-based vertical market solutions and AI development and management tools. The acquisition will create a dynamic organization that drives substantial revenue growth and scales enterprise AI solutions worldwide. AIP's affiliate network operates around the world, blah, blah, a bunch of industries. The combination will provide opportunity to leverage Railtown AI Conductor product as a platform of choice for AI application development by AIP's current and future affiliates and their end user clients. One of the fundamental objectives in the establishment of AIP's affiliate network was to allow AIP to identify and acquire the best affiliates as part of a broader strategic roll-up strategy. The transaction is expected to provide the resulting entity the benefit of a public company structure with access to capital markets as it executes its affiliate acquisition strategy. AIP's established affiliate network provides a significant opportunity to create growing recurring revenue streams through affiliate acquisitions. These revenues could be enhanced by deploying Railtown AI's proprietary technology across all of these affiliate networks. The company plans to acquire select high-performing affiliates, and as a result of combining their product offerings, will provide a rich suite of vertical market AI-based applications and development tools. They will have platform integration. Railtown's AI Conductor platform could streamline AI development for these affiliates and their clients, their end users. They'll have expanded partnerships with Microsoft, NVIDIA, AMD, and etc. They're going to focus on recurring enterprise revenue, the integration of AI-based vertical market applications, and etc., etc. To facilitate the acquisition, Canaccord Genuity has been engaged as exclusive financial advisor and lead agent. Both companies are working toward finalizing a letter of intent to formalize the acquisition in the coming weeks. The acquisition is expected to position the company to capitalize on the rapidly expanding demand for AI solutions in key sectors. The ability to provide enterprise clients with a fully integrated suite of AI tools and services ranging from SaaS applications to advanced development platforms will give the organization a strong competitive advantage worldwide. This came out February 11th, 2025. It states in the press release that I'll just read it again so I don't make it up. Both companies are working toward finalizing a letter of intent to formalize the acquisition in the coming weeks. So that was released on February 11th. I think that's when I had my eye. I think that's the day I had my eye replaced. So anyway, that's 1 week. 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks, 7 weeks, 8 weeks ago. And it says here both companies are working toward finalizing a letter of intent to formalize the acquisition in the coming weeks. That was 8 weeks ago. I don't know what it means in the coming weeks. I don't know what that means. Does that mean 20 weeks or does that mean 4 weeks? I don't know. Obviously, 8 weeks have gone by. One of the dynamics here is that any client of Canaccord Genuity Corp is not going to be solicited to buy the company stock whilst this deal is pending. It means that the shareholders of Railtown will not be buying the stock while the deal is pending. It means the investors in all of the companies, 160 companies, probably all of the investors, but a good chunk of them, will not be allowed to invest. So the stock goes down. So Rebecca Kurzweil, exciting news, Railtown. This includes two guys who, I can't read it backwards. So Railtown announces an MOU to acquire AI partnerships. This includes John Ruffalo and Omer, who are the financial architects of Constellation Software, CSU, $100 billion value, $4,900 a share. Then she posted, oh, she deleted that one. Well, I won't read it then. She deleted it, so I'm going to leave her privacy. But she pointed out that the companies have a great deal of revenue. I'm not going to. She deleted it, so I'm not going to repeat it. So anyway, that's Railtown. No need for the extended answer, but thanks. Bar chart lists RailF as 100% sell. It's a computerized. Let me look. It's a computerized indication, and it's for traders. And if you're day trading it, maybe you want to sell it. I wouldn't, but the video was up quite a bit today, it looks like. It's slow. Sorry. It's going to take a second. Anyway, while it freezes, it's just price action is why it says sell. They don't talk to anybody. Look, Pete, Canada's a small market. Canada has fewer people in the whole country than or about equal to California. It's a small market. So nobody's buying the stock for 8 weeks since the memorandum of understanding was announced, nobody's buying the stock that's big, that can. Nobody. Not allowed to. On top of that, the news that came out used the term memorandum of understanding, and it implied in a future date they'd have the letter of intent. And I can't remember if it said they needed to raise money or not, but it said they're going to use Canaccord, so it implied it. These are all little data points that computers pick up. They start selling the stock. Why do they do that? Well, if they can sell 10 million shares, 100 million shares from 36 down to 25, when Canaccord comes out and asks for money from these hedge funds who are fronts for the criminals, they've just sold stock that doesn't exist. They've put money in cash. Cash is fungible. They put money in the prime broker sitting there. And when Canaccord calls up, they probably doesn't even have to call up. They just call Canaccord themselves. Hey, we're ready to get, if you have 100 million shares, we'll do it at 23 cents or 20 cents. Sure, let's do it. Boom, bang, bang, bing, boom, boom. And the company gets diluted. Instead of at 36 cents, it's at 20 cents. And the bankers are proud. Adina Friedman is proud. Everyone's proud. And the shareholders get screwed by dilution. You've seen it over and over again. MULN, CRTD, VOCL, MMAT, Torchlight, MMTLP, Finger, all the collective audience crap with Aubrey Advisors. Root. You've seen it in stock after stock after stock. You don't need me to explain it to you why the stock is down. That's why it's down. Because the announcement that they're mandated to put out says MOU. Computer says so. The announcement says we're working on an LOI. Computer says so. Hired Canaccord, implying they're going to raise money. Computer says so. What's in it for the criminals? Well, they start selling the stock down. They know the company is in the middle of an acquisition. They know the company needs money. And it's not locked in. They sell the price down. So what are the scenarios? The company moves forward with the merger. They ask Canaccord for 25 million. Well, when Canaccord makes the calls, it's done at a discount to the current market price. They've already sold it down. They have $25 million, 30 million sitting in their prime broker from unlocated, undelivered trades. And boom, they cross it and they made 30% on their money. That's one scenario. Another scenario is by selling it down, they bust the trade. The CEO says, we don't want to merge anymore. Well, then the company is sitting there flat on its back. The other company's gone away. The company needs money, and it doesn't have a deal that's going to make its life better. It's even better than the first situation. When the company goes to raise money, it doesn't try to raise 25 million, it just tries to raise 5 million to stay in existence. But by that time, the stock price is down at 4 cents. And the guys that shorted it down, they killed the deal. They busted the deal, but they already have the money sitting there in the account. When Canaccord goes to raise money, they cross it, boom, they even made more money. They even made more money. Those are the, and then you can have combinations of those scenarios. No one can buy. It's like shooting fish in a barrel. No one can buy. And you've seen it over and over again. I don't know why you... So what happens in the case of Railtown is you have to count on the guys having done it before, which they have. Brandolini, his team of guys have done it before. This guy Omer and the other guy with Constellation Software, they've done it before. I don't trust Canaccord any more than I trust Roth. But these guys have real wealth, and they don't need Canaccord. They can pay Canaccord a fee, but they don't need the cheating. So one has to be comfortable assuming that the merger is going to go through, and it's going to go through at a price that is attractive to both parties. And none of this selling off is going to change that. Is it a safe bet? I don't know, but I don't think it's going to break up. The other thing is, in the United States, there's a lot of people who bought the stock and expected quick turnaround. Here it is months later. They may be selling, they just need the money. You never know. But there's according to the people I talked to, there's very little selling in Canada. Very little. And then you had DeepSeek come through, which I think was a fraud. But there's no question that China has stolen our technology. We've given China our technology. China does partnerships when they give money, so they get the technology. George W. Bush allowed them to walk down one of our stealth planes. They have the stealth technology. They have electric vehicles. Apparently, they're getting chip technology that's better than ours, maybe. They have better schools. They have 70% graduates. So China may beat us in AI. But I don't think it was DeepSeek. But DeepSeek popped the bubble. So maybe that delayed everything a little bit. And then just recently, last week, the markets crashed, and yesterday they tried to crash again. And it's all about China. It's all about tariffs. It's all about everything you read in the news. But it might just be that we were due for a correction, in my opinion. So in that environment, people who own Railtown own other stocks. They might sell Railtown to buy into other stocks. They might just sell Railtown because they need the money. They might panic. They might think, they read the headlines and it says that AI is over with, and it's a freaky time. People are selling. Nobody's buying though. Nobody's buying. So when you look at bar chart, which I think, has it given me? No. Let me try again. It says last price 26.50, first resistance 27.43, second resistance 28.35, third resistance 29.65. That sounds right. Support 25.21, 23.91, and 22.99. To me, it's a great risk reward. Bar chart opinion, I guess that's it. It says 100% sell. 100% sell. Bar chart. And the stock went up today. Overall signal calculated from 13 indicators. Long-term measurement of historic strength of the signal. The signal. The signal indicates. So their trend seeker, which is their own signal, says sell. 20-day moving average says sell. 20 to 50-day moving average crossover says sell. 20 to 100-day moving average crossover says sell. 20 to 200 moving average says sell. 20-day average volume says sell. 50-day moving average says sell. 50 to 100-day moving average crossover says sell. 50 to 150-day moving average crossover says so. 50 to 200-day moving average crossover says so. Long-term indicators all say so. The average, sell 100%. That's why. Let me see if I can see the chart. That's the chart. It doesn't look that bad to me. The only negative I see in that chart is it's going sideways, and sideways is time, and it opens it to selling downward. By going sideways, it has broken the support by going sideways. On the other, well, one support that you could draw. On the other hand, it's above the support levels of the last year. I don't think that chart screams sell. Anyway, I would buy that stock. I would buy Railtown, Pete. If I had money, I'd buy it. I'd much rather buy it. I've just given you the fundamental story. I'd much rather buy it while it says 100% sell. It'll probably have to go above 40 cents or 50 cents before they start saying 100% buy. I don't find that a useful indicator, but I'm not a technician. So if you're a technician, what that would tell you is you should put orders in under the market if you want to own it. Maybe put it in at 20 cents or 22 cents. But I think you're going to miss it if you don't just buy it at whatever the price is right now. I know it's patience is the hard thing. It's frustrating. And to have some of the, I mean, these are all horses headed for the glue factory. One of them might win the Kentucky Derby if they get injected with a hormone, and then the prize will be taken away. but they're not. These are not Secretariat and I can't remember the other big horses back there. At War Admiral and those. I doubled my position in Finger. That's great. Will the China tariffs affect Finger? Yeah, of course I will. The trade war will affect Finger. The deterioration in our relationship with China will affect Finger. But I think I can't figure out China right now because the news I'm looking at is not official news. Official news, everything's hunky-dory. But I think something's going on in China. I think they're just to summarize, I think they're in a depression in China. I think money is coming out of their system. I think bonds and real estate, people even, are disappearing. I think China is in a depression. And what one aspect intrigues me, which is, are our banksters doing this? Are they going to get China's gold? Because we've gotten everything else. We did it to Russia. We did it to, in different degrees, we did it to Iraq, to Libya, to Venezuela. We did it to our friends. Are we doing it to China? But we'll find out. That'll be something after the fact to think about. But the positive in China is they've got a ton of money and a ton of gold, and they've got the ability, as best I can tell, to print yuan in China. It's like they're the world's biggest economy or second biggest economy, depending on what you give credit to currencies and et cetera. But we're the biggest, and we can just print money. This chick, idiot chick, what's her name? I always got to look her up. Stephanie Kelton. Print money, just modern monetary theory. She looks off in distance as if she has a brain. Drives you crazy. Well, we get to do it because we are the world's largest economy, and we have consumers, and the dollar reigns supreme. But it doesn't take much to figure that China can copy a lot of that. So anyway, China might be printing money domestically. Someday, the United States is going to have an international dollar and a domestic dollar. And if we can get through this, so we own silver, we own gold, we own income streams that have value, and we're out of debt, and we can be our own central banks, it won't matter that internally there's the US, the domestic dollar, and externally there's the international dollar. But it's coming. Our lifestyle is going to change. So anyway, I think what China's doing is printing a lot of money domestically, and they're doing everything they can do to prop up their economy. I don't know if I'm right on this because I don't see it in the mainstream media, but I think China is going to use our terms, they're going to go full bore quantitative easing. And I think that's good for Finger and their contract with these automobiles. But, we'll find out. Look, Finger is going to announce their earnings in a week. I expect there's going to be great information in that release, and it could change the story. But there's also odds are they're going to lose money in the fourth quarter. They want to earn money in the fourth quarter, but odds are they won't. So, but that's okay. That's okay. It's going to be what they describe for 2026 or what we can extrapolate, and that'll matter. I think they're going to have to raise money, but they could do that with a joint venture, or maybe the government just gives loans like we did to everybody except white straight males. Well, no, I think some males got that. I didn't. I wish I had known how to do it. Anyway, I think it'll be all right for Finger. Anyway. I think we came to the end of the questions. Let me just see if there's any news. I wanted to go further. On that basis trade. Here's an interesting article. NASDAQ futures. NASDAQ surging. Sell low, buy high. Sounds like me. Size is forced buying. So maybe the shorts are having to cover. Anyway, I think I'm not going to read it. I'll do it maybe tomorrow. But I think this basis trade unwinding I think there's hedge funds in trouble. And I think that's why interest rates are going up on some of these bonds. And that's a little bit scary. But I think what it means is the Fed is going to expand the Fed's balance sheet by trillions of dollars to bail out too big to fail hedge funds. And the names on these funds, Citadel's one of them. But anyway, everything's slow, so I can't pull it up to tell you. So anyway, it's almost 6 o'clock. Let me see if there's any other news to talk about. Let me look at the prices on the close. GBUX closed 707. Pfizer 22.5. That guy was telling you to buy it at 25. GTII didn't really trade, I don't think. It shows 8 cents, but I don't think it traded. No, I don't think it did. Well, it shows volume of 31,000 shares. I wouldn't buy that. Let's see where Finger closed. Finger closed at $1.30, or that's extra hours, so that's pretty good. All right, I don't see any more questions, so I'm going to sign off. Thank you for watching. PS71. All we can do is wait. I think it'll be worth the wait, and then I hope it'll be enough of a return that waiting is never the issue again. But I think there's time in the cycle because the money's not going to flow down to the smaller companies right away. It's like I don't know, it's like a water wheel. It's going to go to gold and silver, then the big miners, the ETFs, any product that Wall Street comes up with, they can earn fees on. Then it'll be the middle companies, then the merger and acquisitions. All the good merger candidates will be bought up very quickly. Then research will come out, and then there'll be deals on offer from smaller gold and silver companies. And there'll be a lot of crap deals, and there'll be, and then there'll be M&A activity down there too. But I think in our case, it's going to be weighing the gold, basically, as they say, and then it's going to be I don't think. Well, I don't know. I don't think it'll be a buyout. I think it'll be a joint venture or self-funding, but we'll find out. It's not in my control. Yeah, all right. I'm going to leave it there because anything else will take another hour, and I think it's gone on long enough. So I appreciate everybody tuning in, and GBUX is great. It's it's up 10x since Sam recommended it. I hope there's another 10x in it, but we'll find out. All right. Cheers.